which is against. So the courts technically are divided on this point, but at the same time, at the ground level, there are multiple notices coming in, and the indirect tax manager is typically confused about how to deal with this entire process. Today's session primarily is going to look at this problem statement, and again, not from a past period. We'll be touching upon the past periods, but also from the current year, because there are certain changes, incremental changes, as I was highlighting, which have been carried out in the GST law to try to address to this issue. But before we go into that, what is the root cause of the issue? All of us here are aware that the root cause of the issue is a condition for claiming input tax credit, section 16(2) subclause C, to be very precise. And what does that subclause C say? It says that if you are claiming input tax credit, one of the conditions, and mind you, this is just one of the conditions, there are many other provisions, but for focus, we'll be just talking about this condition today. And what this condition basically says is, subject to the provisions of section 41, the tax charged in respect of the supply has been actually paid to the government, either in cash or through utilization of input tax credit admissible to the supplier in respect of the said supply. So essentially, sum and substance, what this condition tries to bring about is that before you claim input tax credit, you have to make sure that your vendor has paid the tax to the government. And I'm sure as a customer, the first reaction which you will have is the expression which you can see on the first picture. And this is what most of the times clients would come back and say, that look, the vendor has been given a GST registration by the government, and he collects the tax through an invoice raised on me, mentioning a valid GST number. I assume he would pay it to the government, and therefore I have given it to him, because that's the process. I am expected to give him the tax, and he is expected to give it to the government. So how do I know whether he has actually paid or not paid? Then at any point of time, if notices come, the next line of argument is, it's not fair. The look which you can see of this child is again something which most of the customers or most of the dealers will express. They would say that, look, I have paid the tax, assuming that the license or the registration given to the vendor is correct. And therefore, now, after 2 years or 3 years, you issue me a notice saying that, look, I had told him to collect and pay to me, but he did not pay to me. And because the vendor did not pay to me, I'm not going to give you input tax credit. Naturally, the child is going to say it's not fair. Then the looks which you can see on the child's face, I think, is what each of us resonate with. So while at the part of the taxpayer, the customer who has claimed input tax credit and which input tax credit is in dispute, these are the commonplace reactions. The first and the second are the commonplace reactions. When we interact with the government has the standard proposition, which you can see in the third picture on this slide. The government says, if the tax has not come to me, I cannot give it back. The standard saying, which says you can't pour from an empty cup. If the treasury was empty, if the tax was factually not received by the government, how can I give it back to you? Because end of the day, input tax credit is a mechanism to give back a tax already collected. And if the tax was never collected, how can I give it back to you? So that is the version which the government tried to bring about. Today's session essentially is not on the legal merits or demerits of whether the taxpayer's version is correct or the government's version is correct. The session primarily is on how to ensure strategically and practically that we face the least brunt of this dispute. And it's, of course, we cannot isolate or insulate ourselves from the dispute in totality, but having safeguarded to the maximum possible extent, to the limited extent wherever you have an exposure, what would be the way forward, and subject to the fact that there will be some litigation on that front. So in that context, I think we need to look at today's session in totality. And the entire session, I think, is divided into two broad baskets. Firstly, is this question about how do I know whether the taxpayer or the vendor has paid the tax or not. And friends, in this regard, I think there are various time frames which we will have to keep in mind. And while in 2017, and we had extensive sessions wherein we discussed the provisions as were sought to be initially implemented in 2017, the entire process of GSTR 1 flowing into 2.8, which ultimately going into a GSTR 2, resulting in a mismatch report, to be created by the government, and thereafter finally filing a GSTR 3 as a return. Of course, we are all aware a lot of things have flown thereafter, that all these things are not implemented. What ultimately got implemented is a very different workflow, wherein you had a GSTR 1 and a 2A. And thereafter, there is a bit of a disconnect because you straight away filed a GSTR 3B, which had only an aggregate claim of credit. And of course, while this was the intermediary step and which resulted in a lot of difficulties, what we have seen is over a period of time, small changes have been carried out, which I would say are incremental changes rather than revolutionary changes. And each of those changes was perhaps with an aim to try to plug this issue and balance this to the extent possible without disrupting the day-to-day activities to the extent possible. So as of today, if someone asks, how are we going to ensure compliance? I think there could be 2 or 3 scenarios. The input tax credit is reflecting in your GSTR 2A, 2B. We'll go into the difference between 2A, 2B slightly later. With the status of paid, meaning the vendor has uploaded the invoice into your 2B, and when you download GSTR 2A, you find that he has also filed his GSTR 3B, and therefore the status is updated as paid. I think this is the best case scenario. There are no issues. There cannot be any question on claim of credit other than the eligibility related issues. And therefore, I think this is a simplistic scenario. When I'm talking about this, I also need to highlight a small aberration which our office found out recently when we downloaded periodic GSTR 2A. And we find that while there is a column for the 3B filing status of the vendor, which says paid or unpaid, the problem which comes up is especially in the case of quarterly filers. If your vendor is a quarterly filer, in that case, for the months of the 2 quarters, 2 months, which he has filed only an IFF, but not paid the taxes through 3B, the 2A shows as unpaid status or not filed status. So in those cases, you might need to specifically go back to the GST portal, not base it only on your 2A. You might need to go back to the GST portal and type that GST number of the vendor and check whether his returns have been correctly filed or not, and accordingly decide whether your transactions are matching or not matching. So that is a small aberration, especially if your vendors are small vendors and are quarterly return filers, that you may need to just check that facet as far as the reconciliation is concerned. Thereafter comes situations where the transactions are not reflecting in your GSTR 2A and 2B. Now, naturally, the condition prior to 2022 was that the vendor should have paid the tax. And at that point of time, there was no specific section which enabled or forced the taxpayers to demonstrate matching. And this has been somewhere accepted by a series of circulars issued by the center as well as the states. In earlier sessions, we've talked about this aspect. And therefore, if the vendor has actually paid the tax to the government, but wrongly uploaded in B2C section or uploaded the tax under some another GST number, which he cannot rectify, in that case, this series of circulars talk about obtaining a certificate from the vendor or his chartered accountant. And based on that certificate from the vendor or the chartered accountant that the taxes have been correctly paid, but only there is a issue with relating to the disclosure in the GSTR 1. Based on that certificate, we are told that the credit will be allowable. So moment you obtain that certificate, then it will clearly be an eligible transaction. Of course, sometimes at ground level or at the first stage, the officer may not look at all the documents and ad hoc disallow, but definitely the circulars are in place, the law is in place, and therefore at some forum, definitely moment you obtain the certificates, you should be able to get the relief. And we are seeing that in many cases, even at the ground level, the officers are allowing, so long as you have these certificates, up to period of 31st December 2021, the officers are also dropping the demands. So up to that period, I think there is a paperwork, there is an administrative work involved, but subject to that administrative work, there is really no big risk as far as the tax is concerned. Now, for this period, there could be a situation that you have already deleted, discontinued business with that vendor, and therefore you are unable to obtain a certificate from the vendor. In these cases, I would believe that you will have to contest the matter on merits and equity. A few of the decisions which we talked about earlier were useful and they can be dependent upon. But yes, this is going to be a bit of a litigative battle. And depending on the amounts, you may decide whether you would like to go through that entire process of litigation or you would like to pay and conclude the matter as far as this area is concerned. So yes, this is one area which will be a bit of a difficulty. This, please note, all of this applies only up to 1st of January 2022. From periods thereafter, we need to take cognizance of an amendment, another condition which has been introduced for claim of input tax credit, which says that the credit can be claimed only if the same is reflected in your GSTR 2B. So if the credit is not reflected in your GSTR 2B, you cannot claim the credit at all. And therefore, the entire discussion, entire basis of these judgments, all of that is no longer relevant from 1st of January 2022. To repeat, from 1st January 2022, even though you have a valid invoice, even though you have paid to the vendor, and not only the base value, but the tax amount also, if the tax is not reflected in your 2A, 2B, you could not claim the credit. In fact, from that period onwards, or in fact, even earlier than that, we have suggested our clients to undergo the monthly reconciliation process before filing GSTR 3B and not claim the credits only on the basis of the books, but claim the credit based on matching between the books and GSTR 3B. I'm aware most of us have been doing it, and therefore I don't see a major challenge over here in terms of demand, because typically most of the clients would have claimed the credits only on the basis of matching. But yes, if there have been aberrations, in those cases, we need to re-understand this provision to say that if there was no matching in the first place, the credit itself was incorrect, and there is really no scope of going into unnecessary litigation on this point. It's only a situation where you will end up doing a course correction by way of reversal today, along with applicable interest, if any. Now, this is a situation where the the tax is not reflecting in your 2A, 2B. Now, there could be a third scenario where the tax is reflecting in 2A, 2B. Therefore, there's a matching status which is coming, but the vendor has only filed his GSTR 1, but not filed his GSTR 3B. And therefore, the status is that the tax is not paid. Now, again, we here need to take cognizance of section 41, the amendment which was brought in from 1st of October 22. And that's why I said that there have been small incremental amendments which have been carried out. And for periods up to 1/10/2022, definitely, because the transaction is reflecting in your 2A, 2B, you could very well contest on merits and equity. DY Bethel will strongly apply to your case because the vendor has actually uploaded the transaction in GSTR 1, but not paid the tax. And if he has not paid the tax, you could definitely put the ball in the courts of the assessing officer of the vendor and tell him that why did he not initiate recovery from the vendor. And therefore, for periods up to 1/10/22, you could contest on merits and litigate. However, for periods after 1/10/22, when section 41, along with that, there's a rule 37A, which has been introduced, which requires a reversal. And we'll be discussing rule 37A in the next slide in a little bit more detail. And that's one of the objectives of today's session. So section 41 read with rule 37A will require that if the tax has not been paid, you have to reverse the credit. And there is a position which says that if later on the vendor pays the tax, you can reclaim the credit which you have already reversed. So that is through rule 37A. And let's therefore understand rule 37A. What does rule 37A basically say? And this entire issue primarily comes up from the filing mechanism. You have a GSTR 1 where a supplier would commit his tax liability. He will only upload data and commit his tax liability, but the tax would be paid on the basis by the subsequent date through a GSTR 3B. So on 11th, he will commit his tax liability, but he will pay it on 20th. Now, the credit is available based on matching, and that matching happens in the intermediary period. On 14th, you get a GSTR 2B, and based on that, you will match. So therefore, at that time, since the due date of paying the tax itself is not over, the paid status cannot be updated. And therefore, when you are matching GSTR 1, GSTR 2B with your purchase register on a month-on-month basis during a financial year, you will not be able to ensure, you will only be able to ensure that the transaction has appeared in GSTR1 and therefore in 2B. But you will not be able to ensure that the tax has been paid by the vendor or not. And therefore, the law also permits you to claim that credit during the financial year. But what it says is this credit is there. You can claim that credit, no problems. But at the end of the year, do a rerun of that entire exercise and check whether the vendor has filed GSTR 3B. In the month of September, you check that up to 30th September, if the vendor has filed his GSTR 3B, no problems. That credit which you had claimed is re-strengthened and there is nothing which you need to do. But if the vendor has not filed his GSTR 3B for the previous year, that is financial year 22-23, by the 30th September of the next year, then when you file your GSTR 3B for October, at that time, you have to reverse the credit. And this October GSTR 3B has to be filed by 30th November. Of course, the due date of 3B is 20th of November. But here you are given, in that sense, not a concession in filing a 3B, but a concession for ITC reversal up to 30th of November. So you reverse the ITC in the GSTR 3B of October. And if not reversed till that time, then you have to pay the interest. And as I said, if subsequently the vendor files his old return, then you can reclaim the credit if you come to know that he has filed his old return. So this is the rule 37A, which essentially becomes applicable for the first time. And that's the objective of today's discussion, that this is one more process step which has been introduced in the entire process of the return filing status which we are doing as of today. And someone, and I would not say someone, I would say most of you would feel that this is one more exercise, one more difficulty which has been sought to be presented to each of the persons or the implementers. And many of us who are compliant taxpayers would feel that, okay, it's just 1% of the dishonest taxpayers which keeps on adding to the burdens of the other 99% taxpayers. To some extent, I would believe that yes, the concerns are genuine and the discomfort which each of us has is genuine. But I would just like to step back for a moment, and I would believe that we need to look at this entire provision from the viewpoint of materiality and what could be the possible damage. Yes, this provision in 17-18 could have created havoc, but coming to a situation of 23-24, wherein, as we have seen, some of the incremental changes have been brought about, and many of them, other incremental changes are there. Maybe the materiality of this transaction could be very low. As a random exercise, we tried doing that in one of our clients having around 7,000 row items. And we could see there was an aberration of only 3 or 4 items in that. And that 3-4 items was also having a very insignificant amount of a tax component. So yes, there is a provision like this which requires you to do an extensive reconciliation one more time. But maybe the end result of that reconciliation may not be a major financial impact which might come in. And that is something which we need to bear in mind. Of course, there is a provision, so you will have to take care that you comply with it to the extent possible. And why I'm saying that there is such a big change in terms of the unmatching or the non-payment of taxes, that the materiality has reduced to such a drastic extent. And I think for that, we need to understand small changes which have been brought in the entire compliance workflow from time to time. We are all aware of this broad compliance workflow. We have been doing this workflow day in and day out. At a transactional level, today, we have transactional level IRN being generated at the time of generation of the invoice itself in most of the cases. We'll go into the detailing of the IRN also. The e-way bill is also auto-created in case of an IRN. In other cases, of course, any movement of goods requires an e-way bill. So at a transactional level, there's an IRN e-way bill compliances. All of this automatically flows into a GSTR1, which goes into the GSTR 2B or 2A of the customer. The claim of credit under GSTR 3B is now linked to a large extent with GSTR 2B. And finally, you have an annual return and reconciliation in the form of GSTR 9 and 9C. This, as we all know, is a standard compliance workflow wherein there's a sequential flow of data from one phase of the compliance to the other phase of the compliance. Of course, to a large extent, certain things are amendable, but yet there are linkages internally. And that those linkages, internal linkages plus the validations is what, if we understand the purpose and the background of those validations, we may be able to realize that really this is not a big issue in the sense of the term. So we have a few slides wherein we'll just revisit a few of the compliance checkpoints. Most of them are basic and all of you are aware of those things, but just for the sake of completeness, we'll be talking about it with a focus again, as I said, on the important aspects of validations. We are aware IRN, we started initially with people having a turnover above 500 crores. And I would believe that IRN compliance is e-invoicing is one major success factors in the GST network. When it started with above 500 crores, today we have gone all the way down to 5 crores. And we are aware that effective from 1st August 2023, which is already implemented, e-invoicing is mandatory if aggregate annual turnover in any of the preceding years is greater than 5 crores. And even for people who are below 5 crores, we are told that you can voluntarily choose to do an e-invoicing if you wish to. So essentially, if you look at it, I would believe that a substantial, more than 95-98% of the space is today under the e-invoicing provisions. E-invoicing is applicable for B2B, B2G and export transactions. B2C, it's not applicable, but anyways, from a customer's perspective, input tax credit is only in case of B2B transactions. And therefore, there you will find that in most of the cases, there will be an e-invoicing applicable. Now, the situation which comes is moment you say e-invoicing is applicable, a substantial amount of punching errors automatically vanish because the invoice number, etc., is automatically there on the portal. Now, therefore, to a large extent, those types of errors can be eliminated. More importantly, two-factor authentication is also made mandatory. This is again a technical aspect which comes in. If your aggregate turnover is about 20 crores, then two-factor authentication is again mandatory. So you will have two different questions before which you can log in into the portal. E-invoicing portal, as we are all aware, is based on the login mechanism, and therefore, to a large extent, it is a secure mechanism as compared to an e-way bill mechanism, wherein e-way bill, anyone can generate e-way bill on behalf of someone else. And therefore, there are certain challenges around that front. In e-invoicing, because of this login and two-factor authentication, there's a lot of security of the information which is being submitted. Of course, we are aware that once an e-invoice is generated by the vendor, it can be cancelled only within a time frame of 24 hours. Thereafter, he will have to either follow the credit note, debit note route, or he can go in the GSTR1 and amend it. So two options available to him. One more thing which is being brought in is that for taxpayers having turnover above 100 crores, an outer time limit of 30 days is proposed for reporting of e-invoicing. Now, if you really look at Rule 48, Rule 48 does not actually provide any flexibility of delay. It basically says that before you generate an invoice, you have to obtain an IRN. And therefore, while the portal does permit you, as of today, a flexibility to upload an backdated e-invoice, a rule is in conflict with it. And even if you upload a backdated e-invoice, the means the portal permits you, but the law can be questioned. You could be questioned by the law because technically you are not supposed to generate an invoice itself without an IRN. And therefore, there is always that conflict. But now, even the portal will block the issuance of a backdated e-invoice beyond 30 days with effect from 1st of November 2023. Therefore, if your process of e-invoicing on the output side is not strongly recommended that you relook at the process. Today, it's much simpler. There are many IRPs, private IRPs who have also been appointed. And therefore, there are many options through which you can try to automate this process of obtaining an IRN and uploading it at the time of the generation of the invoice itself. Now, friends, the IRN or the e-invoice which is generated has strong linkages with three different documents. The first is the GSTR1 of the supplier itself. So every time an IRN is generated, it flows into the GSTR1 of the supplier. And in a later slide, when we talk about the GSTR1 compliances, we'll talk about how this IRN process simplifies or complicates the process of the GSTR1 filing. It also goes on to the GSTR2A of the counterparty. Depending on the IRP through which you choose, it either goes on a real-time basis or on a T+2 basis. So this is one check. The first question which we had in the slide, how do I know? So this is the first cross check which is now in a way available to a customer to check whether the vendor has uploaded the transaction on the GST portal or not. In fact, the invoice itself has a QR code which can be scanned by any standard scanner. And you can check the validity of the invoice through a normal scanning software also. Or you can download your GSTR 2A and find that the invoice, whether it is available there or not. And it will also be, the IRN will also be available in the GSTR 2B of the counterparty on the 14th when the GSTR 2B is generated. So therefore, there are linkages of this IRN with not only the supplier's GSTR 1, but also the customer's GSTR 2A and 2B. So that becomes an important touch point which we need to bear in mind. Before we go into GSTR 1 and 2B, just a little bit of a detour. Let's quickly look at e-way bill compliances. Again, this is something which has been stabilized over a number of years, but a quick rebrush may be important. E-way bill, as we are all aware, has to accompany movement of goods if the value is above a particular limit. If it's a supply, you also have to accompany it with a tax invoice, and that tax invoice will also have an IRN. We are aware that when you are doing an e-invoicing, there is an option to move from e-invoicing straight away to the e-way bill portal, and the e-way bill can be automatically generated based on the data populated in the invoice itself. If it is not by way of a supply, meaning it's an intrastate branch transfer or a goods being supplied as a part of a service or self-movement, in those cases, you will accompany the e-way bill with a delivery challan. Please note that even in case of non-taxable transactions, otherwise than by way of a supply, also a e-way bill would be required. We are aware that e-way bill is equivalent with movement. In case of no movement, no e-way bill is required. But if there is a movement, irrespective of tax or no tax, e-way bill is required. The e-way bill is valid based on the distance of movement. It can be generated by anyone. Now, this is something where I would want to pause for a moment. That today, the e-way bill portal, unlike the IRN portal, is a little bit vague. It permits not only the supplier, but also the recipient or the transporter to generate an e-way bill. And therefore, whenever an e-way bill is generated, the details of the e-way bill are communicated by SMS to the registered mobile number of the supplier or of each of the stakeholders. Now, we are told, the law says this, that if there is something which is communicated by SMS and it is an error, you can reject that transaction, the proposed e-way bill transaction, within a period of 72 hours. And the law also says that if you are not rejecting it within 72 hours, there will be a deemed acceptance of the transaction by the stakeholders. Now, these two bullet points by itself can create a lot of havoc. Luckily, we have seen that the department as of now has primarily concentrated on 2A, 2B, etc. And e-way bills, only of late we are seeing an emphasis on e-way bill by the department. But this could be a potential weapon in the hands of the department, because what we practically see is in most of the organizations, the e-way bills are generally handled by the logistics team rather than by the tax and finance teams. And most of those cases, because of the volume of SMSs being generated, none of the organizations have actually gone ahead to identify or institutionalize a process wherein all e-way bills generated are verified, and if they are wrongly generated, especially by third parties, they are rejected so that this aspect of deemed acceptance doesn't come into place. So this is one area which you have to be slightly careful about. And as time progresses, maybe we will find some action on this, and maybe as a response to that action or otherwise, organizations may need to really build up mechanisms to have a bit of a more robust mechanism to ensure that your e-way bill compliances are appropriately handled. Over a period of time, what has happened is there has been an important amendment which has been brought in over here, which says that if an organization does not file 2 consecutive GSTR 3B returns, it will result in the blocking of the e-way bill facility. Now, why is this important? This is important from the context that today, most of the vendors, if their e-way bill is blocked, they cannot regenerate invoices any longer. They cannot sell goods. They cannot buy goods. And if that happens, necessarily, therefore, there is a check which has been brought in, that the person will go ahead and comply with the requirements of filing GSTR 3B returns. So this is a deterrent at the part of the vendor to ensure that he files the returns in time. Again, there are stringent penalties of 200% of the tax in case of movement without valid e-way bill. Again, highlighting the factor that yes, e-way bill compliances have to be taken a lot more seriously than what are being taken as of today. Now, with that detour, we come back to our broad discussion, which is relating to compliances on the outward side. So at GSTR1 level, as we had talked about in the IRN, the data is auto-populated into the GSTR1 with a facility to edit. Now, why is this facility important? The facility is important because IRN, there is a time limit of 24 hours for deletion. There is no edit facility under the IRN portal, which is a separate portal, and GST is a separate portal. And because there is no facility to edit, there will be a situation wherein there will be a reconciliation. There could be examples where IRN has been wrongly generated, data has been, some clerical errors have happened, or initially you would have contemplated a transaction, but the transaction didn't happen actually. Therefore, you will have situations where there is data on the IRN portal, but the data is not there in your books because the transaction did not get consummated. At the same time, there would be, because most of the places the e-invoicing is linked with your main operational software, there could be examples like sale of fixed assets or other activities, some select transactions where at the time of raising the invoice, the organization did not generate an IRN or forgot to generate an IRN. So therefore, whenever the GSTR1 has to be filed, there is typically a download of the IRN data and a reconciliation of that IRN data, which is undertaken with the books data. And then, depending on the situation, you may like to reconcile that data and update the unmatched records in either the books or on the IRN portal. So that is one strategy, and which is the most recommended strategy. I'm aware that this might require some time. And therefore, some companies, though we are not suggesting this option, but some companies may choose, there is a facility that you can reject all the IRN data proposed by the GSTR1, and then after deleting all the data, start with a clean slate and upload your sales register totally. Now, when you do this, the risk which happens is that the IRN linkage, the source linkage gets deleted. And because the source linkage gets deleted, your customer data, the customer, when he looks at his GSTR2A, he will not be able to link the IRN with the transaction. And therefore, he might feel that you are not filing an e-invoice in the correct manner. And therefore, my belief is that ideally you should go ahead with a reconciliation, and only unmatched records you should try to match and make the necessary changes accordingly. Now, again, in GSTR1, there are provisions wherein an entity, the facility to file GSTR1 is blocked if a previous GSTR1 is not filed. So they have brought in a sequential filing of GSTR1. So if you have to file GSTR1 of September, you should have filed all the GSTR1 up to August. If you have not filed the earlier GSTR1, you can't file the current GSTR1. So that is the first process of blocking, which is known as the sequential blocking of GSTR1. That's not all. If your previous GSTR3B is not filed, then also you cannot file GSTR1. Earlier, this blocking was not there. So what happened? People used to file GSTR1, and because there is no tax payable in GSTR1, tax payable will happen only when the GSTR3B is filed. And they will conveniently delay the GSTR3B on some pretext or the other. Now, that is not possible. At the most, only one cycle of GSTR3B can be unfiled. Beyond that, you cannot have an unfiled, because if you are not filed 3B, you will not be able to file the subsequent one. And therefore, it's only 1 month's delta that can be unfiled as far as the vendor who wants to, do a jugaad can work upon. Again, we are told that if there are previous notices under 1B and 1C, and we'll be talking about these notices also in some time, if they are not responded, then also you are not able to file GSTR1. So all in all, the entire process of filing GSTR1 itself has now all these locks. And because of this blocking, it's important, and it automatically brings in a discipline at the vendor's end to make sure that they comply with the specific requirements of the law. And if they are complying with the requirements of the law, I come back to my original point to say that today, the materiality of non-compliances at vendor end reduces drastically. That takes me from GSTR1 to GSTR3B. Again, Like IRN data flowing into GSTR1, the GSTR1 data also auto flows into GSTR3B. Again, this is amendable because there could be timing differences. There could be other data like B2C, and so there could be some clerical errors also. And therefore, while there's an auto population of GSTR1 data, there is a possibility to edit it. Another important facet which happened in GSTR3B is there's an auto population of ITC data through GSTR2B. And this is where a circular which was issued in August 2022 becomes very relevant. We had a very detailed session and most of our clients have adapted to this new process. And what the new process basically says is whatever credits are appearing in your GSTR2B becomes your starting point for a claim of credit. And thereafter, you have to do a temporary and a permanent reversals. And we've taken a detailed session explaining all of that and thereafter arrive at the current month's eligible input tax credit. And therefore, both at the output as well as the input tax credit end, there is a reconciliation which is being proposed at this stage, offline reconciliation, of course. And thereafter, there is an offset and payment which you are doing. Again, we are all aware from day one, you cannot file a return without making the payment, which is identified in the return. And therefore, you cannot have a situation where there is an unpaid tax as per a return filed. Now, that's where many organizations, again, Jugadu mentality comes into place. People will disclose a transaction in GSTR1, but because they don't have money to pay the tax, they will underreport the transaction in 3B. And this is where the law provides for a deemed tax liability. And now we have a form DRC1B, which says that in a particular month, if your GSTR1 shows a liability of, let's say, 1 crore, but 3B you have discharged the tax only on 50 lakhs. Auto population हो गया 1 crore, आपने वो figure change कर दिया, 50 lakh कर दिया, and you paid tax on 50 lakhs. Moment you do this, you will be served with a notice in DRC1B, again, auto-populated notices created by the system itself, and you will be given an opportunity to explain. Because there could be a genuine situation, there could be a credit note, there could be a situation of previous month's credit note which could not get adjusted, or there could be an error कि 1 crore नहीं होना चाहिए था, वो 50 lakhs ही होना चाहिए था, लेकिन you will amend it in the subsequent GSTR. So therefore, they have brought in this process called DRC1B. You can, moment the DRC1B is issued to you, you have to respond to that notice. There's a standard template which has been given there in 3 or 4 standard reasons. You put those reasons which the documentary evidence is, and accordingly you upload it. If you don't respond to DRC1B, you will not be able, we talked about it in the earlier slide, you will not be able to file the next GSTR1, and the demand which is mentioned in DRC1B will then become a part of a normal show cause notice, and the litigation route will start immediately. Today, all this is happening after 4 years through the ASMT 10 or the DRC1A process. But maybe next 4 or 5 months, you will start all of this getting operationalized. And the moment it starts getting operationalized, you will find that your entire thing will be, like fresh in memory. And within 3-4 months, all these issues will start coming to the forefront. And when we look, therefore, at all these factors, as of today, if the vendor does not comply, what are the types of possibilities and what are the safeguards available? So at a vendor, you could have a situation that the vendor raised the invoice but did not report it in GSTR1. Now, the safeguard available to the customer is you are told that you can easily verify this through your GSTR2A or 2B, and you hold back the payment. I'm aware many organizations nowadays do not make the payment to the vendor until the tax is reported in the GSTR2A or 2B. So maybe you can also institutionalize that mechanism. As it is, this time gap will not be more than a month, and therefore you could ask the vendor to wait for the tax component for the month up to the 13th of the next month, and only on 13th or the 14th once it appears in your 2B, you will make a payment of the tax component, and therefore at least to a large extent you are safeguarded from the issue of non-compliance by the vendor. Second situation is vendor reported invoice in GSTR1 but did not report it in GSTR3B. We just discussed that there is a DRC1B process will be initiated to recover the tax from the supplier. It could also lead to cancellation of registration at some point of time, because if that 1B is not responded in time, then there is a demand which will get created, and then ultimately there could be a cancellation of registration as well. And therefore, there's a substantial risk at the vendor's end in terms of non-compliance over here. Of course, despite that, if it's a big ticket item, there could be, if the vendor's non-compliance could result in a difficulty to you. The third scenario, someone might say is, the vendor reported the invoice in 3B but did not pay the tax. Now, that is not possible, as we already said, that there cannot be an unpaid tax in 3B. And therefore, this scenario is ruled out as a test case example itself. The final situation is reported invoice in GSTR1 but did not file the 3B at all. The second scenario which we talked about was 1 crore versus 50 lakhs. The fourth scenario is the vendor reports 1 crore in GSTR1 but thereafter does not file 3B at all. Again, you can re-verify whether he has filed 3B by looking at GSTR2A. Now, at this point, you will find that I have been talking 2A, 2B differently at different points of time. Essentially, both those documents are similar. Both of them show the credits given by the customer, by the supplier. The two fundamental differences between 2A and 2B is 2A is a dynamic document and 2A is the sorting of the credits based on the invoice date. Therefore, if there is an invoice of March 23, it will appear in your March 23 2A only, irrespective of when the vendor has uploaded. If the vendor has uploaded in March, it will appear in March 2A. If the vendor has uploaded in September, you will have to re-download the March 2A and it will appear in the March 2A only. As compared to that, GSTR 2B is a static document, because once you have a dynamic document, in the initial years, we face this difficulty that always the figures, whenever you download the document, were different. The totals were different. And therefore, people faced a lot of challenge. And therefore, 2B was created, which is a static document, which basically talks about all the credits irrespective of the invoice date. It is sorted based on the filing date. So from 14th to 13th is what is the cycle year, because 14th by 13th all the GSTR ones get filed. So 14th to 13th cycle being the filing date, if it is filed in time, all those data will come in the GSTR 2B of that particular month, even if it pertains to a previous month's credit. Now, one more factor is because GSTR 2B is based on a 14 to 13 cycle, it does not have a payment status. For checking the payment status, you will have to re-download the GSTR 2A and you will realize the aspect about the payment status only in GSTR 2A and not in GSTR 2B. So I think these are the two major differences between 2A and 2B. So typically today, of primary importance is GSTR 2B, because that is what you will use while claiming your input tax credit and matching. But GSTR 2A becomes important at the end of the year when you are going to re-verify the process of the actual tax payment through cash by the vendor in case of matched transactions. So we have this situation where if the GST vendor has not filed his 3B, you can re-verify through the GSTR 2A. You could also check it independently on the GST portal by putting his GST number. We also need to bear in mind that if the vendor does not file his GSTR 3B, e-way bill gets blocked. We talked about it a few minutes back. And there is a cancellation of registration if 6 returns are not filed by the person. So therefore, because of all of these, the possibility of non-compliance by the vendor therefore also reduces. Now, when we are looking at all of these, we now come to our situation, because I'm sure in most of our organizations or our clients and the people who are represented on this group, all of these negative aspects of non-compliances are not relevant, because naturally there are institutionalized processes for payment of taxes and outward supplies being uploaded and all of that. But all of this was important from a perspective of understanding the extent of non-compliances by the vendors and its impact on input tax credit. Now, with that background, we come to our initial value proposition to say that how are we going to really claim the credit and what are the compliances required on the inward side for an ITC claim. Again, just to reiterate, we are aware that from 1st of January 2022, the credit is available only on the basis of matching. And from August 22, we have a change in disclosure requirements through the circular. We are aware that GSTR 2B becomes the starting point of claiming the credit. So for a particular month, whatever is the credit which is disclosed by the vendors in GSTR 2B, you should start with that number. You will naturally do a matching. Just because some value is there in 2B, you can't claim the credit. There will be examples of ineligible credits or block credits. There would be examples of invoices not accounted in your books or not approved in your books. There would be cases where you have not made the payment to the vendor, etc. Some of them may therefore require, either a permanent or a temporary reversal. Permanent reversal would be examples like ineligible credits. Credits which you are never going to claim would be permanent. Whereas temporary reversals would be a situation where today you are not claiming the credit, but at a future point of time, you will claim the credit. And therefore, the return itself has been amended, wherein we are told you will start the credit with GSTR 2B, the claim of credit. And thereafter, there will be a reduction of permanent reversal and a reduction of temporary reversal. Now, I'm sure there is also this issue of timing difference. And therefore, whenever we talk about temporary reversals, there is a recredit of temporary reversals. And the recredit has to be shown separately in the returns. Now, the basic challenge is structurally, the credit which hits into your electronic credit ledger hits through one row of your GSTR 3B. And that row is a total of both the basic credit, matched credit for the period, plus the reclaim of temporary reversals. And therefore, there was always a challenge that people who could still play around with the system and claim more credit. And so recently, just 10-12 days back, we have an advisory from the GSTN portal that now we will maintain a cumulative track of temporary reversals and the recredit. So there are two columns, as we said, a temporary reversal and a recredit of temporary reversal. And the system will now track that and make sure that your recredit of temporary reversal is not more than the cumulative count of temporary reversals till date. Because you can reclaim the credit only if it was reversed earlier. And now the problem here is that we are now going to maintain the track from August 23. So what happens to period prior to that? So the GSTN portal says we will give you a window where you can go and update your opening balance as on 1st August. So up to 1st August, check all the temporary reversals which you have done and check all the recredits which you have taken from the temporary reversals, net it out, and whatever is the difference becomes your opening balance as on 1st of August 23. And you are given a time frame of up to November to report the opening balance. Now, I am aware that this is a very complex exercise. Then even the GSTN portal is aware, and therefore it says that you might report the value and you can amend it up to 3 times till December 23. So 2 or 3 options of amendments are given to you. But it's important that all of us really plot this number and update the opening balance in a correct manner. So if I have to just summarize this aspect, what we are told is moving forward, if your ITC claimed in a particular month in a 3B is greater than the ITC populated in 2B plus the reclaim. First scenario. So you have claimed ITC of 1 crore, your 2B shows 50 lakhs and your reclaim shows 10 lakhs. So naturally your ITC claim couldn't have been greater than 60 lakhs, clearly a no trigger point for notice. Or a second scenario, your reclaim is greater than the past reversals including opening balance. So here you have claimed 10 lakhs, but your old past reversals and opening balance is not more than 3 lakhs. Again, that will be a trigger point of a notice. Then there will be firstly a validation and a warning at the time of filing the return also. And thereafter, if this is crossing certain limits, then a fresh notice will be issued in DRC 1C. You will be told to explain the reasons for this difference or excess claim of input tax credit. And if you are not able to explain, then a show cause notice will be issued. Just like we had 1B on the output side, we have 1C on the input tax credit side. So therefore, both of these along will make sure that your timing difference and the challenges which we face through ASMT 10 being issued 4-5 years down the line will try. They are trying to now address it or prepone the issue so that at least the problem can be nipped in the bud. Now, the action point, therefore, clearly from today's discussion, there are 2 action points. Just to step back, the first action point is implementation of Rule 37A, wherein you will check the vendor's tax payment status and the GSTR 3B filing status. And if they have not filed the returns or not paid the taxes, pay that, reverse that much input tax credit in the GSTR 3B of October month. The second one, which we are right now talking about, is the computing of the opening balance of a temporary reversal which has not been reclaimed till 1st August 2023. Now, how do you find that opening balance is a question which most of the organizations and participants here might be facing. And I think the answer to that is twofold. I would believe most of our clients should fit within the first bullet point. If the circular issued in August 22 is followed, naturally this data from August 22 onwards should be available in your returns, because there are two different columns, and if the data is correctly plotted, you can take the netting out of those. You can go back for your to your GSTR 3B returns from August 22 and pick up the numbers from there. But for earlier periods, you will have to either look at your accounting records or your Excel records and find out how much is the credit relating to the earlier period, which has been temporarily reversed, because that data or this entire circular became implementable only from August 22. And there could be cases of earlier period, and there could be many examples. It could be an example of not appearing in 2B, which is a very commonplace example, or not appearing in books. But there could also be situations where you would have reversed the credit on account of non-payment within 180 days. Or you could have reversed the credit on account of Rule 42 with a hope to redo the final working at the end of the year. So all those temporary reversals which you have done earlier with a scope of reclaim, all of that can be checked. Now, of course, if your accounting is perfect, you can also take guidance from your accounting records. There will be a deferred account in your accounting records, and maybe you might check that that deferred record definitely becomes a part of your opening balance. Please note, the deferred information from accounts is not the only information which will come in opening balance. Opening balance will be the deferred account plus the transactions appearing in your 2B but not appearing in your books. So what I would say is your GRIR transactions will also become a part of your opening balance. So you can plot that opening balance. If the circular is not followed in practice, then clearly this is a red signal, and we need to be, be a more proactive, and an immediate shift to the new mechanism will be required. And for the past period, one will have to recompute the deferred credits as per books, deferred credits as per 3B, and thereafter plot the opening balance. And when you are going to do this, you might also find that if you have not fully followed the matching process, there might be an exposure towards reversal of credit or payment of taxes as well. So that also needs to be borne in mind when we are looking at the recomputing of the opening balance. So I think that was from my side, and I think this summarizes. We are towards the just at 6:30, and therefore I think looking at the time, I think we have been able to do that. I think we have a few questions, so we'll try to take up those questions first, and then maybe we can open up also if there are some more doubts. You can put it in the question box. Just give me a second, I'll read the questions and then. So I think the question is, if temporary reversal of financial year 22-23 balance is still lying after time limit of October 23, permanent reversals should be done or not? So an important question, for once the credit has been claimed and temporarily reversed, thereafter there is no time limit for reclaim of the credit. Therefore, even if there is a balance lying, you can reclaim it at any future point of time, and this has been clarified in Rule 37 very clearly. So it will not apply it will not create a difficulty in that front. On this aspect, I think one more question which was coming was its impact of this circular and the temporary reversal and recredit story on GSTR 9. Because as you recollect, in GSTR 9, there is a table which compares the 2A credits with the gross credits claimed. And therefore, there is a possibility that there will be a huge difference appearing in the table in GSTR 9. Now, we were aware of this issue, and over the last 2-3 years, we have tried to address this issue by putting an annexure to GSTR 9, wherein we report only the net amount in the timing difference. And if you refer our GSTR 9 workings of the last couple of years, you will find that in the differences we report the timing difference column, we report the credits claimed in the next year as well as the reversals component. And once we do that, perhaps this issue gets resolved to a large extent. Atul has a question. Rule 37A will be applied on invoices issued on or after 1st of October 22, or whole invoices pertaining to financial year 22-23. I would believe because the section 41 itself got implemented from 1st of October 22, it would apply only to invoices thereafter and not to the original earlier transactions. Okay, there's a question from Ritesh whether opening balance of ITC needs to be uploaded from August 22 only or previous year's data as well. I would believe it will be the previous data as well. So long as it is an eligible deferred ITC, you will have to show this. You need to keep in mind the objective. If it is not in your opening balance and later on you try to claim it, there will be a situation that there will be a negative amount shown because you never put it in the opening balance and you claimed it. Therefore, it will trigger a notice. And therefore, my suggestion would be that wherever you have a doubt, it may be better to err on the side of, a slightly higher quantum of credit being disclosed in the opening balance. I am aware that, this may amount to a bit of a challenge, but please note that when you put it in opening unclaimed balance, it does not mean that you have claimed the credit. It is only at a subsequent point you are claiming a balance. To that extent, the value which you are going to put in the opening balance is slightly notional in that sense. And therefore, one may really try to look at, because otherwise you will keep on getting notices for this activity. We have a question from Arjun whether e-way bill is required from transfer of goods from a godown to another business place if value is more than 50,000. The answer is yes, you are required to raise an e-way bill for movement of goods from one godown to another business place. So I think these are some of the questions which we had. I hope you enjoyed the session. And just to summarize, two major implementation points. One is Rule 37A, and the second one, which we talked about, is the identification of the opening balance. I am aware the next few months are going to be hectic. Our newsletters have tried to bring out all the compliance deadlines. We have the annual ratio Rule 40-43, which has to be complied with by September. We also have the annual returns which are due by the December, and of the last few years we've seen that there have been no extensions, and therefore it's time for each of you to engage with our relationship managers and make sure that the data is submitted in time so that the returns could be filed in time. And finally, these two specific additional compliances which we just talked about today. I think that's all that we have from our side. Thank you very much, and we'll be in touch.